Pfizer, ticker PFE, is currently trading at $40.39 and is down by 24.19% over the last year. If we have a look at the 5-year chart, we can see that Pfizer has been on a fairly bumpy ride over the last 5 years, managing to increase by 21.22%. Now, would this sudden decrease in price indicate that Pfizer might be a buy now? Well, many people do believe that Pfizer is indeed a pandemic stock, or a stock that rose in price only due to the pandemic and the drama caused by COVID-19. I do partly agree with that, but if we have a look at the maximum graph, we can see that Pfizer has been steadily rising since 2010, and only at the beginning of COVID, the price started fluctuating to now end up at $40.39. Now, to understand whether this price is the best price you should be buying Pfizer stock at, we'll jump over to my stock analysis tool, where we will analyze Pfizer using the 9-pillar analysis and find its intrinsic value using the Grams formula revised, discounted cash flow analysis model, multiples valuation model, and the dividend discount model. Now, if we jump back to statistics, we can see that the current dividend yield of Pfizer is sitting at 4.06%, which is really decent for a pharmaceutical company. We can also see that the cash per share is at $0.41 per share per quarter, and the payout ratio is sitting just below 30%. The current analyst's target price for Pfizer is $51, which is $11 higher than the current trading price. If you look down here, we can also see that the current beta of Pfizer is sitting at 0.62, which is very low and indicates that Pfizer is much less volatile than the stocks in S&P 500 or Nasdaq. If we look to the left here, we can see that the total revenue, gross profit, and net income of Pfizer have been increasing very well over the last year, which is due to Pfizer being one of the companies that offers vaccines against COVID-19. But now let's jump to the 9-pillar analysis. Here we can see that Pfizer does have a PE ratio below 22.5, which is great. They also do have a 5-year profit margin greater than 10%, sitting at 32%. Now, if we look further down, we can see that there has indeed been revenue growth and net income growth over the last 5 years, but we do have to be cautious when evaluating these two metrics, as I do believe that the growth in revenue and net income has been caused by COVID-19, and that in the next 2 years these two will significantly decrease. Next, we want there to be a decrease in shares outstanding, and that has clearly not been happening, as we can see here, and the shares have increased by 0.44% over the last year. After that, we want the long-term liabilities over the 5-year free cash flow to be lower than 5. Now, this is at 0.64, which is a really good ratio, indicating that Pfizer can pay off their long-term liabilities with their historical 3-year free cash flow. Next, we want there to be an increase in free cash flow over the last 5 years, and as we can see here, this has indeed been happening. Now, I do believe that the increase in free cash flow as well as the increase in revenue and net income growth have been inflated by COVID-19 and will go down in the next few years. Next, we want the price to free cash flow over the last 5 years to be below 20, and as we can see, this metric is currently at 12.33, which is indeed a tick as well. And lastly, we want there to be consecutive dividend growth, and as we can see, that has been sitting at about 4% over the last 5 years. Now we can jump to calculating the intrinsic value. First, we're going to apply the Grams formula revised. We're going to take the earnings per share, which is currently about double the 10-year average earnings per share of Pfizer, slightly inflating the calculated intrinsic value. Nevertheless, we're going to take the earnings per share and multiply by the base PE, to which we add the multiple of the 5-year growth estimate and the growth rate multiplier, to then multiply everything by the average yield on AA Corporation bonds, and then divide everything by the current yield on AA Corporation bonds, getting an intrinsic value of $43.80, which is about 8% higher than the current trading price. Next, let's move to the discounted cash flow analysis model. Here I plugged in the free cash flow over the last 10 years and calculated the average growth rate to be at 11.57%. I then combined this with the analyst's growth rate projections of -8% and got a calculated growth rate of 2.79% over the next 10 years. I used this growth rate to calculate the future free cash flow over the next 10 years and used the WACC to calculate the present future free cash flow over the next 10 years. I summed all this up, added any cash and cash equivalents, subtracted total debt, and got an equity value of $237 billion, which I divided by the shares outstanding and got an intrinsic value of $42.11, which is about $2 higher than the current trading price. Now, something that we do have to take in mind here is that instead of basing the future free cash flow on the present value of free cash flow, I based it on the free cash flow in 2020, as I do believe that Pfizer will not be able to sustain their future free cash flow and it will drop by quite a bit in 2023. Now let's move to the next valuation model, which is the multiples valuation model. Here I compare Pfizer to BMY and MRK. I took these companies' stock prices and divided by their earnings per share to get their price per earnings ratio. I then averaged out the price per earnings ratio and multiplied by the 10-year average earnings per share of Pfizer to get an intrinsic value of $52.18, which is about $12 higher than the current trading price. Now we can move to the final valuation model of this video, which is the dividend discount model. Here I plugged in the dividend payout and the yearly dividend and calculated the average growth rate over the last 5 years. I then used this average growth rate combined with the WACC to get an intrinsic value of $45.60, which is about $5 higher than the current trading price. Now that we completed all the valuation methods, we can move to our final valuation where we average out the grams valuation, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an ultimate intrinsic value of $45.92, which is about 14% higher than the current trading price. Now, as I'm a value investor, I always like to apply a margin of safety just to be sure. And based on the 9-pillar analysis we have done prior, I do believe that Pfizer will keep on rising steadily over the next few years, despite the fact that many investors are currently selling out of their positions, fearing that Pfizer will go down in price due to it being a pandemic stock, which gives us the best opportunity to buy it at a discounted price. Based on this, I do believe that a margin of safety of say 12% will be acceptable, giving us an acceptable buy price of $40.41. If we now jump to my holdings dashboard, we can see that on my watch list, I currently have PFE Pfizer at the target price of $39.03, as I applied a margin of safety of 15%, as I always like to be a little bit more than sure. Overall, I do believe that the fall in Pfizer stock price is due to investors irrationally selling out of their positions, fearing that after COVID-19, the price of Pfizer will drop. But as we saw at the beginning of the video, Pfizer has been on a steady rise since 2010, and therefore I will be buying Pfizer when it drops below $39. With that, if you enjoyed this video, make sure to leave a like, make sure to subscribe, and let me know down in the comments which company you would like me to evaluate next.